What a wild month October has been for the markets. With the S&P 500 rising nearly 7% for the month, but the markets still down over 18% for the year. Nevertheless, there are still plenty of chances for long-term dividend growth investors. In today's video, I'll focus on 4 firms in particular that I think present a buying opportunity for the month of November. I'll actually be purchasing these companies as well as others that are similar to them myself. Let's get started. First stock company, Broadcom Incorporated, ticker AVGO, an American manufacturer, designer, and supplier of infrastructure software and semiconductors on a global scale. With its headquarters in San Jose, California, Broadcom trades on the Nasdaq and is a part of both the Nasdaq 100 and S&P 500. The company's products are used in the data center networking software, broadband wireless, and industrial markets. Hewlett-Packard's semiconductor sector started off as a section of HP Associates in 1961. The company that exists today is the consequence of various spin-offs and acquisitions that have taken place since then. Don't be put off by the high share price. You can buy fractional shares like I do. This sort of thing shouldn't ever stop you from investing in a firm that meets your requirements. Year to date, Broadcom is down roughly 30% and is trading in the 480s at the time of posting. It is one of my favorite companies in the semiconductor industry, and there are many reasons to admire this company. Over the past 10 years, its shares have increased by more than 1,200%. With all that price growth, you might expect an overvalued company. But that is not the case at all. They also pay a dividend that is increasing at one of the fastest rates in the market. Broadcom is currently trading at 11.42% PE, which is below its 5-year average of 13.8% and lower than the 19.1% for the information technology sector. Broadcom's dividend yield is 3.52%, which is 6% higher than its 5-year average, indicating that the stock is slightly undervalued. The total annual dividend payout of $16.40 per share, the dividend is paid out in quarterly installments of $4.10 per share every March, June, September, and December. Take a look at this incredibly aggressive growth history. Over the past 5 years, dividend growth has increased by 43% on average over the past 11 years. Currently, this is slowing down. The most recent reading was 14% in December of 21. Very outstanding rate of growth. However, we shareholders are anxiously awaiting information on the following increase for the approaching December 2022 payments. Now that we have an understanding of why they were able to develop at such a remarkable rate, we can look at their revenue increase, which was $2.36 billion in 2012. It was $31.7 billion in the past year. The only drawback I can see is the issuance of shares, which have increased significantly over the past 10 years, leading to shareholders' delusion because the returns on the stock match those of a growth firm. Companies will act in this manner when everyone is buying up their stock, but it's something to watch out for. I'd like to see them buck this trend and perhaps begin purchasing some of these shares back now that they are at a discount or lower price. Our second stock company, Union Pacific, ticker UNP. Owning Union Pacific is equivalent to owning the railroads and making an investment in the American supply chain. Founded in 1862 and with its headquarters in Omaha, Nebraska, the rail network stretches over 32,000 miles and connects the Pacific Coast to locations in the American Midwest and Gulf Coast. Union Pacific is also one of my favorite stocks and has an exceptional history as a compounder with good dividend growth numbers. They are the largest railroad by market cap at $126 billion. Even in 2022, railroads continue to be one of the most economical ways to move resources and goods, and this corporation has a moat that very few others can match. Shareholders who merely buy and hold this one have done fairly well, sitting on a 227% gain only in price. That doesn't include dividend income. Union Pacific is currently trading at roughly $200 and is down 20% in the last year. Union Pacific is currently trading at a PE of 16.23, which is a few points below its 5-year average of 19. This suggests that now might be a good time to buy some shares. It's also worth noting that this PE is somewhat below the industrial sector average of 17.9, which stands at 17.9. Another quality I look for in a company that's ready to purchase is a dividend yield that's significantly higher than the 5-year average. Union Pacific's dividend yield of 2.64% is 27% more than the 5-year average. Union Pacific pays its dividends in March, June, September, and December each year. The current quarterly distribution is $1.30, or $5.20 per share annually. The dividend payment ratio for Union Pacific is a reasonable 45% of projected earnings and 53% of free cash flow. With 15 years of continuous dividend increases, which have increased by an average of 14% annually over the previous 5 years, Union Pacific has been a fantastic dividend growth investment for investors. The company announced 2 rises in the past year, and as a result, we have seen an 11% increase. I feel that part of this was caused by the dividend distribution being somewhat stagnant during the uncertainties of those first few months of the COVID epidemic. Even though it has been cyclical, income has increased over the past 10 years, and Union Pacific conducts annual buybacks. There were 952 million shares outstanding in 2012, and as of 2022, there are 631 million. Each time shares are repurchased, the shares we already own increase in value, since they now own a large portion of the company. Although there have been some labor issues and rumors of a strike, it is still my opinion that Union Pacific will continue to grow over the next 150 years. For investors like you and me who wish to hold quality companies like this, I believe that these kinds of things could present a wonderful long-term potential. I usually purchase this one in a few of my accounts.
Let me know in the comments if you have any other questions about investing. Let's return to the video.
The third stock company, Next Era Energy Incorporated, ticker NEE. It's the largest electric utility holding company in terms of market capitalization, a subsidiary of American Energy. More than half of the people in Florida receive their electricity from Florida Power and Light, a part of the firm that also generates the most renewable energy from sources like wind and solar. Next Era, which is now down 10% year to date and trading at $81.64, strikes me as one of the greatest ideas in the sector for the coming year. Next Era is currently trading at a PE of 25.19, which is a little lower than its 5-year average PE of 27.6. I am a buyer of a stock and it trades at a higher price than many of its competitors, with an utility sector average of 17.9. You are paying for quality here. Air Energy pays out 58% of its projected earnings and dividends, which is below the preferred level of 75% for a utility firm. The dividend yield is 2.16%, which is exactly in line with its 5-year average. Although you are giving up some current yield in exchange for dividend growth, their track record of dividend growth is much stronger than what you would typically expect from a utility. They have a 26-year history of dividend growth, making them a dividend aristocrat with a 12% growth rate over the past 5 years. For a utility that generated $14.3 billion in revenue in the previous month, and about $20 billion in the previous 12 months, revenue growth has been gradual but steady. If you really do not like paying any high fees here, the ETF XLU is a great alternative because it offers broad sector exposure at a very affordable expense ratio. For our fourth stock company, National Retail Properties Incorporated, ticker NNN. A real estate investment trust called National Retail Properties Incorporated makes investments in prime real estate bounded by long-term triple net leases. The owners of the restaurant chain Golden Coral originally incorporated the business as Golden Coral Realty Corporation to give its staff members an opportunity to invest in the business. They currently have a diverse portfolio of 3,305 properties spread across 48 states with over 380 tenants, and they have a 99.1% occupancy rate. Among their top tenants are 7-Eleven, LA Fitness, Taco Bell, Arby's, Dave & Buster's, AMC Theaters, and Best Buy, to name just a few. NNN is trading just around $45 at the time of publication and is down more than 5% year to date, making it a great option for real estate investment without the hassles of being a landlord. The price to adjusted funds from operation is 13.3, which is somewhat below the sector average of 13.7 and its 5-year average of 15.5 for the same measure. Investors can purchase national retail properties for a great yield of 5.12%, which is roughly 11% higher than its 5-year average yield of 4.6%. This could be a sign that a stock is undervalued, so keep in mind that PE is a useless metric when evaluating these real estate investment trusts. For a total yearly payment of $2.20, NNN pays a dividend per quarter in the value of 55 cents in the months of February, May, August, and November. Keep in mind that because NNN is a REIT, these payments are non-qualified, meaning they are subject to ordinary income tax. The national retail property has a proven history of dividend growth, having paid dividends for 34 years and increasing them for the last 32 years at a pace of 3% per year during the previous 5 years. For a stock yielding over 5% like this, gradual but steady growth is okay. Additionally, you can mark the box next to healthy revenue growth, since in 2012, sales stood at $352 million, while they increased to $762 million over the course of the previous year. NNN, in my opinion, is among the greatest businesses in the sector for exposure to real estate, with a portfolio that is well diversified and not unduly focused in any one particular field of endeavor. Lots to like, and I believe this is a good moment to be looking at their shares. They have very strong dividend fundamentals for income investors, and one of the greatest dividend growth track records in the real estate market. As promised, here are 3 more companies that I think are interesting at this level and are all high-quality businesses that you should add to your watch list. The first is Vici Properties, ticker symbol VICI. I added this real estate investment trust as another one for myself when the price fell below $30, and there have been possibilities for that over the next few weeks. Owning this business allows you to access some of the most luxurious resorts and tourist attractions throughout the globe, including the numerous legendary hotels on the Las Vegas Strip, which is currently yielding roughly 5%. T. Rowe Price Group, ticker TROW, is the following extra choice here. While we wait for things to come around, this one is looking like a really enticing long-term investment. The yield is at 4.7%, the company has almost no debt, and it has a remarkable track record of dividend growth. And finally, Microsoft, ticker MSFT, another stock I think dividend growth investors should be looking at right now. Simply said, it is one of the top firms in the world. Though a dividend of 1.21% is nothing to get excited about, I prefer it under 230. And if it drops below 200, I'll be adding to my present investments. They increased this dividend at a 10% annual pace, and in the past 10 years, Microsoft stockholders have seen an increase of more than 650%. This is the firm that will be keeping most of my money for the foreseeable future, and I believe that its valuation has now recovered to a respectable level and merits a place on your watch list.
Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button, and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.